Hey, fixed income guys. Last video for the semester. Once again, let me reiterate what kind of pleasure I had to teach you. It was very good. You've been an awesome class, and I'm actually very, very happy with you, with your performance. With your reaction to my materials, and I really like the material that I'm teaching. So what I'm going to do today, I'm going to record, because of popular demand, I'm going to record some videos about mortgages, right? And this video is going to be basically beyond the materials that we taught in class. I'm going to once again explain a little bit more detail the mechanism of the mortgage market in the United States, so that you will know. This is not going to be part of any test. This is just for general education, that you guys will be able to draw and talk about mortgages in an intelligent way when you go to your interviews. And of course, I know that most of you graduate this year, and of course, best of luck, to your interviews, and I hope that you'll get great positions in all the banks, and you'll be, you're rock and rolling. By the age of 30, hopefully you will retire. Okay? So I'm going to talk today about mortgages in the United States. Okay, so what I'm going to explain, right, how the mortgage, big picture, how the mortgage market in the United States works, and then in subsequent videos we are going to repeat some of the calculations, right, that we did in class. Okay, so basically, the mortgage market in the United States, right, is actually run by the government. So you have two agencies. Okay, this is Freddie Mac, Freddie and Fannie, that are responsible for the mortgage market in the United States. Okay, so what their job is, okay, is to provide enough liquidity. So if you or somebody else comes and wants to take a mortgage, right, he's able to do it. Now, how they're doing it? So what they do, right, they issue bonds. And then, right, so these are investors. Okay, they issue bonds. Okay, and then what they're going to do, they will take these monies that they get, and they will actually use these monies to fund the mortgage market, the mortgages in the United States. Now, how do they do that, right? It's very interesting. They're not doing it directly. They're doing it indirectly. So what they're going to do, okay, they will use this money to buy mortgage pools from the banks. So what they do is this, right? So you are an investor here. You give money to the agencies that they have bonds here, right? What they do, they go and they fund the mortgage market with this money. Right? So it means, right, that they give this money. They give this money to the banks, but what they actually do, right? They buy mortgage pools. Basically, they buy huge amounts of mortgages, right? And what do they do with these mortgages, right? They do not keep them on their balance sheet. What they do, they once again disperse it to investors, right? So how they do it through what we call a securitization process, that we will talk about maybe in another video, but here, right, this securitization process is basically taking these giant pools of mortgages, right, and they issue bonds which are backed by the cash flows of these mortgages, right? So basically, those mortgages are coming, when you have a mortgage, right? Let's say you're a middle class person, right? You're paying, right, some coupon or some interest or some payment in order to fund this mortgage, okay? These payments are going into this big pool, okay? And those payments are going, are like going through this huge securitization machine, and they are digested, right? Just like when you eat food, you digest it in your stomach. Exactly the same way is happening here, where you have these cash flows coming in, and then using some financial engineering, right, they are basically going out in terms of payments into to investors, right? And how it is done. Now, if you think about one mortgage, it's actually very easy peasy, okay? Let's say that you have one mortgage, okay? Let's say a 30-year one. So and with a coupon of 5%, so you have a certain monthly payment that you are paying, right? And what you can do with this monthly payment, so this is your monthly payment, right? You can say, okay, I'm going to take this monthly payment, and I'm going to distribute it to the mortgage holders. Now, the mortgage holders in this case will not be the bank, which he gave you the mortgage, but he actually, let's say, sold it to these agencies, right? And this mortgage payment is going to go to the agencies. Right? So there is going to be like a pass-through, right? It will go from the mortgage to the bank, and then the same 5% coupon, the monthly payment will go to the agencies. And what the agencies is going to do, it is going to distribute this payment among three investors. Investor 1, Investor 2, and Investor 3. And how it is going to do it, for example? Right. Well, for example, you have a 5% coupon here, so it will give this 2.5%. This guy, let's say, it will give 1.5%, right? This guy is going to be, 1%. So overall, you are going to get 2.5 plus 1.5 plus 1%, so 5%. Okay. So that's kind of the idea, right, of a securitization that we saw here, right? So now I spoke it in this video. Okay, that's fine. Okay, and now this mechanism, right, enables people to fund the mortgage market in a much more liquid way than it used to be. Because when banks are actually doing that, okay, banks have much more limited capital than this kind of giant machine of public markets, okay? And the banks would, it would depend on their seasonality, because, for example, at the beginning of the year, they would have more money, right? At the end of the year, okay, they would have less money. So people that, let's say, that wanted to get mortgages, right, at the end of the year, would maybe be in a disadvantage, okay? The bank, right, would not by purpose, but inadvertently, because it has less money, right? At the end of the year, you have budgeting to the next year, and you have kind of less money, okay? Not inadvertently, but not by purpose, right? But because it has less money, it may start putting more difficulties for those people to get mortgage, okay? So this kind of securitization machine, right, was set up by the government in order to facilitate, home ownership in the United States, and in order to actually avoid the case where you can have, less availability to mortgages, right, if you are coming to get a mortgage in a certain period, right? Okay, now, what is the bank doing, right? So in this particular case, you can see that it goes from investor to agencies, right? What is the bank is doing, right? So in this picture, so we know what the agency is doing. It's kind of, doing all this securitization. What is the bank doing, right? So here's what's happening, right? You have some sort of a bureaucratic job that the bank needs to do, right? Because, for example, if you're an investor, if you're a mortgage holder, you need to pay the coupon. You are not paying the coupon directly to the agency. You are paying the coupon to the bank, right? And then the bank needs to take this money, take it to the, to this pool that is, overseen by agencies, which it should be, distributed to all these investors, right? Bonds, which are backed by pools of mortgages, need to be distributed to all the investors, right? So this bureaucratic job, which we call servicing, is mostly done by the banks. Okay? So the bank here, right, sits in the middle. It sits between the mortgage payer, okay, and between this kind of giant, market securitization machine, and it collects the coupon, and then it kind of moves it through the pipeline to the agencies, and to these bonds, and to the securitized bonds, and to investors, okay? So the bank actually, okay, doesn't have risks associated with the mortgage. Now, generically, and I'll explain, what do I mean generically, but the bank doesn't have too much risk associated with the mortgage because the mortgage is actually owned, right, by, the agencies and by the bonds which the agencies have created, right? So it does, it does create a lot of other interesting problems, but that's a different story, right? So as the banks basically collects a servicing fee for this, for this kind of service facilitation, right? So Wells Fargo is the biggest mortgage in the United States. It's also one of the biggest services, and this is actually very profitable. Okay, it's profitable because on the one hand you don't have too much danger, right? On the other hand, okay, you have service fee which comes from you, right? And the more mortgages you're issuing, the more money you will make. So that's why it creates, this inherent interest for the banks, right, to create this kind of, of a mortgage, of mortgage facilitation. Now, prior to 2008, right, the banks were much more liberal. The banks were much more liberal of issuing those mortgages, right? Now, this actually indirectly or directly, whoever wants to look on that, right, caused the crisis, the credit crisis in 2008, and almost took the economy, the U.S. economy down. Okay, since 2008, the banks actually had tightened, right, the criteria by which they issue mortgages. Okay, and it actually caused some criticism from the regulators that they are, actually doing too much. They tighten the screw too much. They don't want to take too much risk. Okay, so that's the big picture. Now, what I'm going to do next video, I'm going to explain, the biggest types of mortgages that we have in the United States, right? So we have some types of mortgages, and in the next video after that, I'm going to explain, okay, what type of mortgages we have in the United States. In the third video, we will do some calculations. Okay, so that's that's the main video, and hopefully you kind of benefited from that. Thank you, and have a great day.